Good day to you. Adam Gower here on the GowerCrowd.com podcast with the second of my conversations with wealth managers or registered investment advisors, RIAs. Today, my guest is Tom McKeon of Clothier Springs Capital Management in Phoenixville, Pennsylvania. Think about the pivotal role that wealth managers like Tom play in the world of real estate crowdfunding. As a sponsor, you're going to be spending a lot of time trying to find high net worth investors, right? Accredited investors, one at a time through your social media posting, website educational content, maybe through list acquisition and management, or through advertising. But at the end of the day, you're trying to reach individuals. Wealth managers are the force multiplier for this effort because these folk have already done all the hard work and their contacts and client networks are large, relationships of trust have already been built, and they advise on investment strategies. It's a marriage made in heaven because these folk may never have had the opportunity to invest in commercial real estate before. So at the same time as you are teaching them about the industry and the opportunities that CRE investing have and offer their clients, they are providing access to their networks to you. Today, you will hear from Tom why he likes private real estate for his clients. You'll learn some of the tax benefits and other reasons that Tom's clients consider private real estate for their portfolios. You'll learn the single most important thing an RIA needs to keep in mind. And we'll have a candid look at the risks of investing in private real estate through an RIA. Tom has also structured his real estate investing within his practice in a very interesting way, so be sure to listen out for how he does that. Now, to reiterate what I said last week, I am not a financial advisor, so I do not give financial advice of any kind, but Tom is. So feel free to contact him if you have any questions or would like to know more. You can find all his contact information on the podcast page for today's episode at GowerCrowd.com, where you will also find links to the whiteboard workshop, which is a training that shows you the exact system we put together for our private real estate clients to raise money online for their projects. It's no good getting a wealth manager behind you if you don't back them up with some first-class content on your website so that when their clients come to check you out, you do the introduction made to you justice with a high caliber response, right? In terms of what you've got on your website. So find out how to build your own investor acquisition system and help out the RIAs in your network by watching the whiteboard workshop on the podcast page there at GowerCrowd.com. That's it. Let's get into it now with Tom McKeon of Clothier Springs Capital Management to learn more about what it takes for an RIA to invest in private real estate. Tom McKeon of Clothier Springs Capital Management, thank you very, very much indeed for being on my podcast today. You are a registered, correct me if I'm wrong, you are a registered investment advisor, wealth manager. And I am very interested to know how you came. Let's just start right at the top, right? And then we'll work our way through some of the details. How did you come to invest and advise your clients to invest in private real estate? Tell me what the path was to get in there.
Okay. So here's how the general story unfolded. I was introduced to a fellow who owns a self-directed IRA business. And I've been in the financial services business for more than 30 years. And when I met this fellow, I didn't know what a self-directed IRA was. And we got together for lunch and he said a self-directed IRA is an IRA that lets people invest in non-publicly listed investments, real estate, mortgages, tax liens, gold, cryptocurrencies, things like that. And I said, that's all well and good, but I don't have any need for that. All my clients are invested in publicly traded securities, ETFs, funds like that. But the guy who owned the business was pretty clever about keeping his own story in front of people. And he has weekly classes and weekly webinars. And, you start to see some of these teasers, come learn about how to invest in real estate flipping, come learn how to invest in multi-family, investments. And I got involved in one of his networking groups, and as you might imagine, there's a fair number of people at the crossroads, people with deals looking for money, people with IRA money looking for deals. And he set himself up at the crossroads, and I started to talk to some of these people, and I thought, these returns are fairly robust. My clients should probably have some of this. So being a portfolio manager, I just thought, why don't I put that together myself instead of buying something off the shelf that's going to cost 3 times more than what I can do it for, because I'm really trying to give my clients the best net returns possible. So that's exactly what I did. I launched this February of 2018. I had a modest goal of trying to raise $2.5 million. We did that. I've made 17 investments. But the real underlying driver is to try and give my clients some better returns than I think the public markets are going to be able to give them in the next decade. And we're talking about returns anywhere from 9, 10, 12, 16%. Now the trade-off is these are illiquid investments, right? You can sell all your stocks tomorrow. We just saw that happen over the last month. It wasn't fun, but that's the price of liquidity, is that you can get.
I'll tell you what, Tom, let's talk about that. Let's kind of drill down and let's talk about it in 2 different phases, if you like. Let's first talk about the pros of from an RIA's perspective, from a wealth manager's perspective. What are the pros of having private real estate in your portfolio? And then let's talk about the cons. But first, tell me about the pros. What's the advantages?
So the pros are somewhat higher expected returns than I think regular investments are likely to provide. It's another asset class, another market exposure, which is uncorrelated to all the publicly traded investments. So I think it brings another level of diversification to a portfolio. Those are the 2 big ideas. And really, my job is to deliver returns to people. And this was a vehicle to do that.
Well, what about, for example, having, I'm going to throw a couple of ideas up actually, like, for example, having a longer term perspective for part of your portfolio, for example, because you can't trade it. I mean, you do have this illiquidity. So
Yes.
Are there advantages to having that? I mean, think about the current circumstances, right? Where we've got this terrible downturn, and overnight stocks can drop 30%, right? Basically, and you look at your what's on paper and you're 30% down, it can be quite unnerving.
Yes, it can.
Whereas with real estate, if you have a long-term perspective, and I'm just going to suggest this to you, if you've got a long-term perspective, then you're not subject to that same kind of market whim, if you like, right?
Absolutely. So my partnership itself strikes a net asset value every month. And the partnership itself is not liquid. So people can't call up and say, get me out. I mean, they signed paperwork that said they have a certain time horizon, they have a certain net worth, they have a certain ability to withstand and to stay in for the long term. None of the investments inside the partnership are liquid. So they don't get repriced every day by panicky investors. So there's all that stability there. Having said that, there's not a corner of our economic world that isn't going to be impacted somewhat by what's going on in America. People who collect rent are going to have to deal with some short-term issues. People who make construction loans are going to have some short-term issues. That's a given. But it could be that in the meantime, people can't panic, sell off their holdings 30% down, and then a month later wish they hadn't.
Exactly.
Right? So
what about tax benefits? Are there any tax benefits from investor perspective of having private real estate?
So as a pooled partnership, everyone gets a single K1. Instead of an individual investor doing 10 different deals and getting 10 different K1s from 10 different deal sponsors, those deal sponsors report all that up to me, and I create a single K1 for people. Most of this stuff will all provide long-term capital gains. Income is going to be income no matter what. Some of these investments will also deliver accelerated depreciation, which is a benefit that publicly traded investments won't provide.
Right. So, that you can, just to clarify for the uninitiated into the tax code, which is something actually that I have an allergic reaction to every time. Accelerated depreciation
Right.
means that you can deduct that against income, and so you pay much less tax each year on the income you otherwise get, correct?
That's correct. And the tax code gives me the same willies it gives you. And I'd like to say, I like to say I defer to my tax advisor for certain things, but that's
Tom, I have a rule. It's the AAA rule, the AAA rule when it comes to anything to do with tax. Ask an accountant.
Yeah.
Basically my rule. I'm not interested.
Yeah.
All right. So actually you've said something very interesting here. So let me just understand how you've structured this, Tom. So am I correct in understanding that the way you have structured this at Clothier Springs Capital Management is that you have created a vehicle, a fund of some sort, into which your clients invest, and then they rely upon you to identify assets to private real estate deals to invest in. So tell me something about why you did that. Just to explain that again for the uninitiated. You know it, you thought it up, but why did you do that rather than putting individual clients into individual deals?
So I've been wearing a portfolio manager's hat for 25 plus years now. Diversification is the free lunch in our world. And instead of having all of your eggs in one deal, it made far more sense to me for my clients to say, why don't we put some of your money in 20 different deals? You now get the benefit of the free lunch. If something goes sideways, and anything could go sideways, you'll have 5% of your money in it instead of 100% of your money in it. So that's the inescapable reality of diversification. It's the free lunch in our world. So my vehicle is just simply an LLC. I created an LLC, but I manage it like any open-ended mutual fund. It's custodied at what's called a qualified custodian, which means they're qualified to hold non-traditional assets that aren't publicly traded. It also means I have to provide all sorts of documentation about the deals, about the investors. I have to provide an annual audit. And that's all, I guess that's all called the Bernie Madoff rule, because it's good to be able to show people that you actually have assets, they're actually held somewhere, and they actually have a value verified by an independent, accountant. So, does that make sense?
Yeah, absolutely. Yes, it's fascinating, actually. So we're definitely probing a world that I'm not that familiar with. I have to tell, like I say, I have the AAA, ask an accountant rule. When it comes to stocks and bonds, I also have a rule that I just leave it up to my guy to take care of that. I know real estate. I don't know anything about stocks and bonds. Truly, really, I've just kind of deferred to a very, very old friend on that stuff.
Sure.
So we are in territory. It's a little unfamiliar to me. So let me ask you this then. So presumably, and I see this through the lens of real estate. So if you set up a fund, and you said you just structured it like a mutual fund, from a very practical perspective, presumably you are able to charge fees. Are you on the assets under management and charge out-of-pocket fees and other fees? That's how you make money as an RIA managing this real estate portfolio, is it?
Yeah, so it's a full pass-through entity. All the expenses and all the returns are completely passed through to the LLC members proportionally. I charge a flat 1%, excuse me, investment advisory fee. But if there's a $10,000 audit fee, the partnership pays the audit fee. If there's a $2,500 qualified custodial fee, the fund pays that. Any income that comes in from the lenders, any income comes in from the multifamily deal sponsors, that all flows straight into the LLC as well. So I really want to make this a complete pass-through and take a nominal fee for my little,
for the work that you do, but it's not so little, is it? So we'll talk about that as well now. Let's dive into that a little bit, because you're being quite modest about what it is that you do. It's a lot of work, I know, that you do behind the scenes to do this. But so for clarification, it is fairly normal to have for an RIA to charge a 1% fee on assets under management.
Mm-hmm.
When it comes to private real estate, that you've created a structure to enable you to continue to do that, right? Because you're basically you're intermediating the relationship between the investor and the sponsors in
Mm-hmm.
your fund.
Mm-hmm.
And so okay, so there's no promote, right? So that's where I was going with this. So
Right.
in your fund, you're not saying to your investors, we are going to invest, we're going to create a fund, we're going to identify sponsors, and we're going to invest some of our own money, and we could be treated as though we were an investor in this fund, and we will take 20, you'll get an 8% pref, as you know, these how this real estate works. And then when assets are sold, we're going to get 20% promote. You're not promoting your investors at all.
No.
This is a strict 1%. That's a very humble take in the real estate world.
Well, that's sort of where I come from ethically. I happen to live in Vanguard's backyard, and I've been imbibing that mantra for years. Clients earn returns net of fees. So I'm trying to enrich my clients and earn a fair fee in the meantime. I'm not trying to enrich myself at their expense.
So let's dive into that a little bit, because one of the driving forces, the core thesis of real estate investment is the idea of an alignment of interests. And an alignment of interests, as you know, comes from making sure that the sponsor and the investor stands to gain together, but also stands to lose together. So in the structure, I'm challenging you a little bit here, right?
Sure.
But in the structure you've designed, you don't have that same, in what way do you have an alignment of interest then with your clients? You know, I've just come from this very biased world where I only see it through the lens of real estate.
Sure. You know, I've never actually thought of it in those terms. My expectation is that all of these investments are going to provide returns. I never really thought a bit about sharing the downside if that happened to be the way it turns out. I just thought at the outset that if I was taking 20% of a client's return, that would be sort of confiscatory, and I just didn't like it.
That's an I've never heard that before. Very good.
I didn't like that. I didn't like that arrangement. I've also seen a couple funds recently being promoted where the deal sponsor is saying to his investors, "Listen, I'm going to give you guys 8%. You know, they can't guarantee anything, but it's going to be a fairly regular 8%, and they're going to take the investor money, turn around and go make 24% or 20% or 16% and keep the difference." And I thought that was a very self-serving way of doing this. So I wanted to serve my clients. To your point, though, I never thought about the symmetry of sharing gains and losses. I'm not going to go revisit my paperwork.
No, I'm not suggesting that you do at all. I'm just curious. I'm truly, like I said, genuinely interested in how you structure and how you think. So let me ask you this then, because again, I think you take, it's a very humble approach, actually, just coming from a real estate guy's perspective.
Sure.
But you take your 1%, and there's a lot of work, isn't there, Tom? It's not a trivial thing to do. So tell me something about the effort that is involved from your perspective, underwriting the deals that you include and in your portfolio that you recommend to clients. And how does that compare with the kind of work that you have to do deciding on what stocks, bonds, and kind of traditional assets to invest in?
In my traditional role as advisor, I'm basically buying market beta. I'm buying U.S. large cap beta. I'm buying U.S. Municipal bond beta for very low cost. So I just, in that arena, I just need to make sure that I understand the asset class and the drivers of the returns there. In the real estate world, I have to actually go vet all the deal sponsors individually. I have to find them individually. I have to have cash when they are looking for money for a deal, because liquidity is not uniform in the private markets. It's not always and everywhere sitting on the shelf for you. So it's important for me to try and have cash when there are good deals available. because it doesn't always match up. But as far as individual deal sponsors, I have to look people in the eye. I have to look at their paperwork. I have to believe that they're good operators. I have to believe that they're ethical operators. I have to believe that their pro forma numbers are reasonable, and that their entry price into the deal is conservative, and that their projections about how they can increase the net operating income is conservative, and their assumed exit rate is reasonable, so that I can say, all right, I can see that this deal is going to do, say, 16% over 3.5 years. And we'll make that our target. So yeah, that's a little bit more of the traditional financial analysis, really, than I do in my day-to-day job anymore. I'm not in the business of analyzing public company balance sheets or income statements. That's not relevant anymore, right? Because I'm not trying to pick one company out of 500 because I think it's going to outperform the index. That's a fool's errand at this point. I don't know whether we can agree on that, but that's my
again. I leave it all up to my guy. I'm not even bothered.
I'm trying to find deal sponsors, and in my journey to get to this point too, I also came across a speech that the head of the SEC gave a few years ago, and at the time she said that there was more money raised in the private markets the year before than in the public markets. And as you might expect, it's true of anything in the human experience. Once you start looking, you can start finding things. And then maybe some guys start finding you because they find that you're raising money and you could be a candidate for their deal. So I've done multiple deals with a handful of the guys that I have money with in Philadelphia, in Florida, in Texas, because these guys are in business to keep doing deals as well. Right? I mean, they don't want to just do one-off deal and go on sit on the beach. These guys all have operating businesses they're trying to grow. So once I get a little comfort with some guys, that's a good thing. But I need to keep building the diversification, the geographical diversification, the deal sponsor diversification, the project type diversification. So I'll leave it there.
Yeah, sure. So tell me something about the cons. We talked about the pros. What are I suppose, let's put it this way, right? The big question that someone might ask, not an investor, but let's talk from the RIA perspective. What are the cons of, or the risks of having private real estate? And I use this interchangeably with the concept of commercial real estate. When we talk about private real estate, we're talking about investing with sponsors, with developers, local developers who are running deals themselves, right? So private real estate, that's what we're talking about. It used to be called country club money. Right. So what are the biggest risks, Tom, from an RIA's perspective? Let's put it that way.
Yeah, sure. So I guess liquidity is certainly a permanent concern. Because as you know, liquidity lets people pay too much for things because they can always feel like they can get out. Secondly, these are all operating businesses we're investing in. And, the world has just gone through something it's never gone through before. And one of the lenders that I have in the partnership has said, listen, we're just going to freeze operations for 1 month. We just want to see what the world looks like. They happen to lend money. They turn around and sell the loans to an investor. That investor has gotten a little sheepish. So they just want to make sure that they're conserving their capital, which is partly our capital. And so I guess that's really the main concern, is that their assumptions about their world, their operating business, their rent stream, whatever it is, isn't going to materialize. That's sort of true for every investment. It's just that you can't get out.
And all right, so let me ask a couple of other things as well. So you are not affiliated with a large company. So you don't have to go through you are your own shop, basically. You don't have to go through an approval committee to decide what to invest in. Is that correct?
I am the approval committee.
You are right. So how many, in terms of the world of RIAs, help me out with this. In terms of the world of RIAs, I don't know how many there are in the country, wealth managers individually, but what proportion are their own approval committee, and what proportion are affiliated with a larger entity that would prohibit them from investing in private real estate deals unless there was some kind of, high-level committee approval for that investment?
Yeah, that's a good question, and I'm sure I don't have a good answer to that. But the RIA world is something I pay some attention to because I try to compete with a number of them, and I am trying to differentiate myself. And this real estate, tool is actually one way to do that. But having said that, I think largely a lot of the RIAs in our world are really relationship managers first and foremost, and that they have an RIA, they're registered, but quite often they just turn around and they dump the whole business on a turnkey platform like SEI or InvestNet. And so the RIA is really not even an allocator, or they're certainly not a portfolio manager. They're really just a relationship manager. So if their vendor can't buy it off the shelf, it doesn't happen. So that tends to be limited to the world of publicly traded investments. Now, having said that, I've seen a few platforms. One's called CrowdStreet. You might be familiar with it.
I'm quite familiar.
Yeah. So, I mean, some of the people we've done deals with actually have their deals on CrowdStreet. I didn't get to them through CrowdStreet because I met them independently. But, I signed up for their platform and I get solicitations, invitations to look at a deal basically every day, which is encouraging in that there's lots of people out there creating deals, and there are going to be more deals for my clients to have money in. And they have a similar profile, and you're probably quite familiar with it. But I can't speak to what the whole world of the RIA looks like.
All right,
certainly I'm an anomaly, doing this myself. I don't know anyone that's done this. Any independent RIA, I don't know anyone that's done this.
Really, in terms of real estate, you mean, Tom?
Yeah.
So let me ask you this. One of the things you said actually before we went live was quite interesting. So I want to actually hit you up for it right now. You mentioned that you have been pitching real estate for a long time, right? So you've got a pitch, you got it down. So I'm going to ask you to pitch me as an investor, but in this context, because you said something else that's interesting. You said it differentiates you in the field of RIAs having this. So imagine I'm an investor.
Sure.
Why should I come to you? And let's anchor that in the real estate perspective. Go for it.
Sure. Well, on its own merits, it's a pretty robust vehicle. If I'm not advising your regular money, because I have some clients that are my RIA clients that have money in the deal, and I have some people that are not RIA clients that are just in my partnership. So, what appealed to them, and I must say, the returns by themselves tend to get a little attention. If I can tell people, again, I can't make any guarantees, but I can say, listen, I think this partnership is going to be able to deliver 12 to 16% returns over the life cycle between the income from the lenders and the preferred dividends from the real estate deals, and then the capital events from when they exit. I'm pretty confident that that's going to come in around there. In the regular RIA world, I'm telling globally allocated balanced clients, if I get you 7% for the next 5 years, I'm a hero, because I think that's what the world looks like. T-bills are zero, bonds are next to zero. Before the calamity, the recent sell-off, the fastest sell-off I've ever seen, I was telling people I think we're in for a sort of a flat quarter. The market's had a 10-year up run, no real pain. I think future returns for the market are going to be quite modest. Let's talk about 6, 7, 8%. 12 to 16 looks pretty good compared to that. How much illiquidity can you tolerate to add that to your mix? So that's sort of the general, maybe too technical spiel, but that's the outline of it.
So what are the most frequently asked questions that you get from prospects? There may be existing clients as you introduce them to private real estate investing. It could be somebody else, right? That is not an existing client. But what are the most frequently asked questions that you get from them when you start talking about this?
Yeah, that's a really good question. I guess once I explain it, I don't get a lot of questions. I try to be pretty thorough up front. I have a little executive summary. It looks like this. Here's the basic outline of the deal. Here's why I'm investing in things like this. Originally, the early thesis was we were going to go rehab homes ourselves. We were going to buy individual properties. And that turned out to be not even possible between the quality of the deals and the pricing of those deals. We abandoned that early on, and we started to discover guys that were just trying to raise capital where we could just write a check. So this is a better use of our time.
That's actually a very interesting point that you make there, Tom, because basically you're saying, look, we recognize that there is opportunity to make money, or at least to diversify into real estate, but we don't really want the brain damage of doing it ourselves, right? Because it's like it's like a full-time job to do that.
Yeah, it's an operating business.
Yeah, you're operating a business. So instead, find pros out there, underwrite them, and then invest with them, basically. Yeah. So you're not doing that work.
Right.
And what about reporting? What kind of reporting do you like to see coming out of your sponsors, and then in turn again, compared to stocks and bonds, how does it compare?
Well, they all have to provide an annual audit. They all have to provide an annual K-1. But beyond that, they recognize that we're investors and we're representing other people. So we get quarterly updates. They're pretty good about, all of them are pretty good about trying to keep us informed about where they are in the life cycle of their deal. They just bought a 30-unit multifamily. They're kicking out some people that haven't paid rent in a year. They're rehabbing, the property. They're, if it takes them a quarter or two to start generating cash flow where they can start to make their preferred dividend, they're very good about keeping us up to speed on that. So, my thesis was I like the cash flow. I like to be able to show my investors that the NAV of my partnership, your money, is increasing a little bit every month. And then when somebody has a capital event, then we'll see a nice little bump. So yeah, they all have to do the same thing I do. Some of them provide me a monthly independent party valuation statement. The others who don't, I just hold my investment at cost until they provide some documentation that I should either increase the value. Haven't had to write anything down yet, but one of the deals accrues the dividends, and they don't pay them out in cash, but they say your $100,000 investment is now worth $103,000. And when they finally have their capital event, it all comes. You get that first, right?
Say, Tom, is it harder to manage a real estate portfolio in the way that you are through your fund than it is to manage a portfolio of stocks and bonds, traditional investments?
Last month, it was a lot easier because the market was doing this, and between the speed of the market decline and the global health crisis, I've never seen people more spooked. Really, it was. I don't know that it's over. Maybe the worst is over. Who can say? But last month, I wasn't focusing so much on paying attention to my real estate deals. They were all operating as expected. Although a couple of them had said, "Listen, we're going to just let the dust settle here and see what the world looks like." So once a deal is vetted and invested, we assume it's going to be in our partnership for 3 to 5 years. So there's no reason to monitor it, in real time. Give me the quarterly updates, give me the K1s and the audits. If you want to have lunch once in a while, if you want me to fly out to LA and play golf, I'll do that.
Well, now we can do Zoom calls, right? So it actually makes life a lot easier because now everyone knows to do it. All right, Tom, you've been really it's fascinating to talk to you. I really appreciate your insights and experience. I'd like to, if you don't mind, wrap up with 3 questions that I ask of all of my guests on the podcast. I'm going to modify them slightly because our conversation's a little bit different. Actually, yes. So let me ask you these 3 questions. First of all, what for an RIA who is thinking about including private real estate in their portfolio or in the portfolio that they offer to their clients,
Right.
what's the most important thing they should keep in mind?
I think ultimately that it will improve the risk and return profile of a client's portfolio. The expected returns are somewhat higher. The correlation is lower. So the efficiency of a portfolio should move north and west. And that's what everyone in my business wants. They want, and every investor should want this, the maximum risk return trade-off, right? This improves that trade-off at the cost of a little bit of liquidity. So ultimately, that's what we're all trying to do, is to deliver better returns and less risk to clients. End of discussion, right?
Perfect. Good. Let's underline it there. Second of my last three questions. Let's see. What has been my question is like this. What has been the hardest lesson you've learned in real estate, doing what you're doing on the real estate side so far? If there is a hard lesson, yeah, it's because you've only been doing it for a couple of years.
Yeah, I don't know that. I mean, I'm on the learning curve here for life, So I can't say that I know everything about this, but I'm trying to get up the learning curve for all the different types of deals that are out there, and they all have their own nuances. We've done multifamily rehabs, we've done multifamily ground up construction, we've done triple net lease, we've done some hard money lending. So they all have their own profile, risk and return profile. So for me, it's just to make sure I understand what are the return drivers, what are the downsides. In general, though, the appeal for me to real estate was it's a tangible asset. There's a real asset there that someone's either going to pay rent for, or pay to buy the house that's built on it, or pay to buy the apartment complex, whatever it is, it's a tangible asset. And that, I think, provides some safety. It's not a cryptocurrency. It's not going to zero, all the equity deals we're in have an aspect of leverage. That's just a given. The equity investors like us, we put up 30% of the money. They go out and get traditional financing for the rest of it. But that's really no different than buying your own house. You put up 20% of the money, you go get regular financing. That's also what drives the returns, right?
Well, presumably the businesses that you invest in indirectly by buying their stock also have debt. It's not like nobody has debt, right?
For sure, yeah. Now what's the third question?
Right, the last question. Here we go. So my last question is, what are your key daily habits that keep you successful? That make you successful?
Wow, that's a great question. I wear every hat in my business. I'm an independent RIA. I do the money management, I do the portfolio management, I do the trading, I do the reporting, I do the programming, I do the real estate deal vetting. So a little bit of it is sort of coming in and seeing what needs to be tended to today. But trying to communicate with my clients, make sure they understand. Last month is a perfect example. My main thesis for my clients is that they should invest like an institution, that they should be long-term investors, and that market declines shouldn't rattle their cage. Well, that got put to the test last couple of weeks. And I finally realized that I'm not so rigid with private clients that I shouldn't say, no, don't get out. What I said to them was, listen, if we need to do something to keep you in the fight, let's do that. If you want to raise a little cash, let's do that. Because what I don't want you to do is get out and miss the next 20% up move, because that's an abject failure on my part. But if you want to do a little bit of this, you want to play a little defense, I'm okay with that. So wearing all the hats at my place, Adam, it's sort of whatever comes up first today, right? But reporting, communication, staying in touch with people, making sure that I try and provide some comfort. I mean, you probably didn't see the article. There's a guy who writes for the Wall Street or for the New York Times, James Stewart, long-term investor. He wrote an article a couple of weeks ago that said, I've been a disciplined investor for 40 years. The coronavirus broke me in a month. Like it spooked him as much as anyone. So I'm getting far afield here.
It's all right. It's no problem. Hey, Tom, we are living in very, very interesting times. It's actually, I looked it up. There's an expression that says, may you live in interesting times. I was pretty sure it was the opening line to a Dickens novel, but it isn't. It turns out to be some kind of Chinese proverb that's actually a curse. May you live in interesting times. Well, we definitely live in interesting times. And Tom McKeon, I am very, very grateful to you of Clothier Springs Capital Management. Thank you so much.
Thank you, Adam. This was fun. Yeah. You'll tell me how I can hook up with your podcast, right? You'll connect with me and I can find out.
I will definitely give you all kinds of links, yes, that you can,
awesome.
You can follow.
This was fun. Thank you.
You're more than welcome. Thanks for being on the show, Tom.
That was Tom McKeon of Clothier Spring Capital Management. Be sure to check out the COVID-19 resource page at gowercrowd.com to access all the resources that I put together for you there to help you through these crazy times. There's a lot there, including some free training, other podcasts, articles, discounts off our flagship investor acquisition system, online master course, and a bunch more. That's all going to be there for you on the podcast page at gowercrowd.com. Plus, you'll find links to Tom and his firm also there on the same page on gowercrowd.com. All right, that's it. Thanks for listening. And thank you, Tom McKeon, for your time with me today. It was a real pleasure talking to you. I really enjoyed meeting you. Thank you, Ed, for the introduction again. Super. Really enjoyed it. That's all for this episode. I'll see you next time. And in the meantime, stay well. And for now, this is Dr. Adam Gower signing off.